This week in the markets is shaping up to be one of the most important of the quarter. Between inflation data, fresh Fed commentary, and the kickoff of earnings season, investors will have a lot to digest. But here's the good news. While volatility has made headlines lately, we're also entering a period that could bring clarity and even some upside surprises. So in this video, we'll walk through exactly what to expect this week and where investors might find opportunity even in the face of uncertainty. So let's get started. So what's the key theme this week? Well, earnings season meets economic policy. Markets are still adjusting to the sweeping tariff announcements made last week by the Trump administration. These new levies, which target a broad range of imported goods, including steel, aluminium, semiconductors, and electric vehicles, go into effect this Wednesday. China is responding in kind with a round of retaliatory tariffs, which take effect on Thursday. So we're entering a crucial window where the economic impact of these moves will start to show up not just in headlines, but in hard data and company earnings reports. Now, despite the headlines, history gives us a useful reminder. When tariffs were rolled out in 2018, markets initially dipped, but quickly recovered once earnings season kicked in. And that's the dynamic many analysts are watching again now. Will corporate earnings cut through the noise? The first major test comes midweek, with inflation data front and center. On Wednesday, we'll get the March Consumer Price Index, or CPI report, one of the most important economic indicators when it comes to Federal Reserve policy. Economists are expecting a modest uptick in headline inflation, mostly driven by energy and housing costs. But what really matters for the Fed and for investors is the core CPI, which strips out food and energy. If the numbers continue to cool, it could give the Fed confidence that inflation is trending in the right direction and support the case for a more dovish tone later this year. Then on Thursday, we'll get the Product Price Index, or PPI, which tracks inflation from the business side. Both reports will be closely watched, but if you see a softening in the data, especially in core prices, it could support a rebound in interest rate sensitive sectors like the tech, consumer discretionary, and real estate. And remember, inflation surprises to the downside have often led to a strong single-day rallies in the market. Also on the radar this week, the Fed's March meeting minutes, due out Wednesday afternoon. This is the official record of what policymakers were thinking during their latest rate decision. Investors will be looking for any signals on when or if rate cuts could begin in the second half of the year. We'll hear from Chicago Fed President Austin Goolsbee on Tuesday and New York Fed President John Williams on Thursday. So there's plenty of opportunity for market moving commentary. But overall, the Fed has maintained a data-dependent stance. And that means this week's inflation prints could set the tone for weeks to come. As we mentioned earlier, Wednesday and Thursday mark the official start of the latest tariff cycle. Investors are still digesting the potential impacts. The most affected sectors are likely to include industrial manufacturing, semiconductors and electronics, electric vehicles, and US companies with significant China exposure. But here's a key takeaway. Not all companies are impacted equally. In fact, Goldman Sachs recently noted that many US-centric firms, especially in small and mid-cap indexes, actually stand to benefit from the reshoring trend and supply chain shifts driven by tariffs. So while headlines might spark short-term volatility, this environment may reward selectivity and reward companies that are agile, diversified, and domestically focused. Now let's talk about sentiment. There's no question markets have seen pressure recently, but underneath the surface, there are signs that investors are becoming more cautious, and that can actually be a good thing. According to FactSet, analysts have reduced their earnings expectations heading into this reporting season. The bottom-up earnings per share estimate for the S&P 500 declined by 4.2% during the first quarter. Now you might be wondering, is that a bad sign? Not necessarily. Lower expectations can pave the way for positive surprises. In fact, companies beating earnings forecasts by just a few cents often see outside stock price reactions, especially when the broader market is nervous. That sets up an interesting dynamic heading into earnings season, which we'll cover in the next video. But for now, let's zoom out. Despite uncertainty around tariffs, inflation, and Fed policy, we're entering a period where real data, not just speculation, could take center stage. That shift can bring clarity, confidence, and opportunity. So to recap, new US and China tariffs go into effect this week. We'll get critical CPI and PPI inflation data on Wednesday and Thursday. The Fed will release meeting minutes and deliver several key speeches. And all of this sets the stage for what could be a very telling earnings season. If you're a long-term investor, this is a time to stay informed, not to panic. The more we understand the real economic signals and the strength of individual companies, the better equipped we are to navigate the weeks ahead. Volatility may be high, but so is the potential for clarity, for signal over noise, and for stronger positioning ahead of earnings. And that's what smart investors are focused on. Thanks for watching. Don't forget to like and subscribe, and let us know in the comments what you're watching more closely this week. Inflation data, Fed commentary, or the new tariffs taking effect. See you in the next video.